And the risk calculation guide, and this has had a big makeover, and it looks a lot more cleaner, and it's just a bit more streamlined as well, and it looks quite fancy as well, which is just quite cool. It's like a dashboard for risk appetite, and it tells us the current state of the market and the sentiment. And so you can see quite a lot of numbers, and you might not be sure what those numbers mean, but it's fairly simple. That 34 or minus 34 tells us that there's 34 bears versus the one bull. So you have to imagine yourself in a room. Imagine that you're one person in a room and you're surrounded by 34 people, and you're buying. Those 34 people are bearish, they're sellers, right? So you can imagine how very skewed the market is right now. And so we should be, in speech marks, be seeing a resumption to the norm. And the norm would be 10 to 1 or 20 to 1 ratio for bulls to bears, but not 34 to 1, where they're basically, that tells us that the herd, the bears, are very bearish, but they're holding. And so we should be seeing them be ejected out of the casino. And that's what we've been seeing all week. We're seeing that number go closer to zero, which would be normal, and that would be good, and that would be a healthy sign that the bears are giving up, because they can't hold and add, because if they do, price will keep coming up to punish them, and they've only got finite funds anyway. So that's what that means. So that would be fairly normal, because we're very skewed. Like I say, if you imagine yourself in a room and you're surrounded by 34 people, that's a lot of people. That's like a London bus, full of people. That's a crowded bus. And it's a very skewed sentiment right now with risk appetite. And because we've gone slightly red, which is telling us that the bears are leaving the casino, they're getting off the bus, shall we say. And because of that, we're not in euphoria. We're now in a complacency mood. So we've got the 6 phases, which is from ChatGPT, and examines these 6 cells. All right, so we've got extreme fear, complacency, euphoria, then dominance. Dominance is when the bulls are in full control and the bears have to leave the casino. Okay, and we're currently, because we've got 2 red cells, we're not euphoria. Okay, and so hopefully that makes sense. That's the sentiment part. We're very skewed, and we have been since the Israel-Hamas crisis, the war in the Middle East. The herd have held short, and they've added for the longest time, and also the fact that we're having all these recessionary indicators as well, and it's causing them to hold on and add. And so that's the sentiment part taken care of. So hopefully that makes sense. We're very crowded. By the time you watch this video, we might not be as extreme as that, and that would be good, because we're at unhealthy extremes. Technicals are fairly simple. It's just taken into account where the indices, how they're performed today. So it takes into account the Dow Jones, the S&P, Nasdaq, Russell 2000, the VIX, the 10-year Treasury yield, the FTSE, the CAC, which is the French index, Google, Apple, Tesla, and then the Dixie. The Dixie is really pumping today. And so what we should be seeing is things correlate, where if we have a stronger USD, we should see a stronger Treasury yield, and we should see a softer indices. We should, in speech marks, but the correlations are something that probably takes into account on the risk calculation, but it's also something that you probably need to know as well. If you've got a stronger USD, sometimes that can indicate some risk off, because the USD is a flight to safety and things like that. So we should see things correlate in speech marks, but we're incredibly skewed. So things are quite out of bonk right now, and they've been very out of bonk since the Israel-Hamas crisis, and they've held short, and they've really gone aggressively short. The top we've ever seen is 37.5, and that was the very top of the QDB risk calc, and so we're close to all-time highs, and If the herd sell today, then we're going to be euphoric, right? So the herd can't sell anymore. They need to get out, and then by them exiting, will then be a nice, healthy top. We have a healthy pullback, and then we can resume some normal market, activity. But the thing is, because they're so short, we're going to carry on pumping on risk appetite. So that's the risk calc, and so that's the weekly shifting on currencies. They've gone really long EU and GU today, this week. Sorry, um, probably because of the FOMC that we had this week, and there was a big dovish surprise from Powell, and everyone and his grandpa and his uncle, they all sold the dollar, and by doing so, it's pushed the dollar higher. All right, so there was a bit of a shock this week from FOMC, and of course, the retail being always behind the curve, they've tried to chase price, and now they're probably going to get caught out. And we've seen that the price has really fallen in EU and GU this week. So that's that really. That doesn't really need too much explaining. Now, the US yield curve might need some explaining. Where in a healthy economy, we should be seeing the 3-month, the 6-month, and the 12-month. They should be down, because this indicates fear near term. There's more fear near term than there is long term. So the big banks, they're anticipating apprehension near term in the next 3, 6, 12 months, more than they do expect in the next 5, 10, 30 years. So they're not too happy about the situation, how things are, and so this in descent, it's moving down, inverted, tells us that it should be risk off, but we come back to this and we are very much risk on. So I think, in my personal opinion, that the retail sentiment is skewed the US yield curve, right? Because they're so bearish and they're adding all the time. It's basically negated this, which is a typical risk off indication. And we've had a 2-year, 10-year inversion for the longest time, and it's actually broken records yesterday. And because of this should indicate a recession and risk off, and the fact that we haven't tells us that the sentiment is probably incredibly powerful, and that's the cause for the indices to continue higher. So this is a really, really, really important tab on the sheet. So hopefully that makes sense. There's the new 6 phases, like the psychology of the market and where we are. We've got broken down the sentiment and where we are, where we were, and the change, and the technicals, where we are, where we were, and the change. And that's it. So hopefully that makes sense. I'm going to talk about the QDB sentiment summary now, and I wish you a good day.